Hello and welcome to a special session focusing on the most important elephant in the room, that is IFRS 18 when it comes to SBR and FR, because this is the most important and critical change that we have seen in financial standards development, which is affecting especially the presentation of financial statements. Right, so it's a major change that is happening, and this is applicable from September 2025 exams for FR and SBR. So we are going to look at what IFRS 18 is, what are the changes it brings in, and what do we need to focus on in order to be IFRS 18 ready. Only when we are ready with IFRS 18, we would be certain and we would be sure to get through without still sticking to IAS 1, right? Okay, so the focus mainly would be on IFRS 18 as a standard in depth, which is going to be very useful for SBR, but FR also you will get an understanding of how entire IFRS 18 works, what are the requirements of IFRS 18, and you should be in a position to apply your knowledge of IAS 1 and transition into IFRS 18 by looking at what have changed. Because there are certain things that have changed, certain things have not changed, right? But the changes that have happened are big, alright? Okay. So IFRS 18 standard named Presentation and Disclosure in Financial Statements was introduced or issued by IASB on 24th of April 2024, right? So it is effective in real world. Practically it's effective from 1st of January 2027, but requires a retrospective application. So from 2026 the companies have to start applying this standard. And for ACCA it is examinable from 2025 September exams onwards, alright? So if you are a student who has studied FR and SBR with old syllabus, or if you are a student who has sat for an exam but could not get through until June session, this is for you especially, because September 2025 onwards, what you studied under June 2025 syllabus is not going to be applicable when it comes to the presentation of financial statements. Alright? Okay. So some of the major changes that have happened with IFRS 18 are categories. Right? Now there are categories that have been brought in. Right? So there are 5 main categories. Then there are subtotals, 3 mandatory subtotals, then there are optional subtotals. Alright? And then there is management defined performance measures, you call it MPM, right? APM is already in the syllabus, it remains, but what is MPM, how is it different from APM, that also we are going to look at. Now these are the main changes that have happened in statement of profit or loss and other comprehensive income, as it called under IAS 1, which is now renamed as statement of financial performance. Alright, statement of financial performance. Alright, so 5 categories, 3 subtotals. These are very important. So presentation as a whole is going to change accordingly. Right, so IFRS 18 requires income and expenses to be classified into 5 distinct categories. So there is operating, there is investing, financing, income taxes, discontinued operations. Now these terms, operating, investing, financing, are not Greek to you because you have been introduced to these terms under statement of cash flows. But here it is different, right? And IAS 7 also has aligned statement of cash flows to align it well with IFRS 18 requirements. Alright? Okay. Now these are the 5 distinct categories that are there. Now we look at what each of these categories mean. Right? Now before you used to present your revenue, your minus your cost of sales, which gave you the gross profit. Then you add other income, then your overhead expenses, right? Expenses. Under this you had category of expenses, right? Admin, selling and distribution, finance, charges, etc. Then you had your profit before taxation, and you arrive at profit for the year. This is how your statement of final profit or loss looked like, and then you had other comprehensive that continued into, right? But now the way you present is going to be different, right? Now you don't have income and expenses clearly defined under sections like, after gross profit to take other income and expenses. Now there are going to be income and expenses that you'll see pertaining to each of these categories under different areas. So looking at operating category, what is this? So this is the default category for income and expenses, not falling into the other four categories. So these operating category is a category that focuses on the main business, the day-to-day business perspective, the revenue, the expenses that are incurred on day-to-day basis is what operating category focuses on. Alright. Then there is investing category. So this includes income and expenses from associates, joint ventures and unconsolidated subsidiaries, cash and cash equivalents, assets generating independent returns. Example, debt or equity investments or investment properties. Right. Now when you take investment properties, IAS 40. Okay. In that there are two subsequent treatment methods. One is a cost, one is a fair value model. Right. When it comes to cost model, there is depreciation. When it comes to fair value model, there is gain or loss on revaluation, right? Fair value, change, gain or loss, right? Before we used to record this under the general other income or expenses category. Depreciation all went under one category, and income all went under other income category. But now the depreciation pertaining to investment properties, since that is the purpose is investing, right? Investment properties, what's the purpose? IAS 40 says it is either for rental or for appreciation of value. That's why you purchase those properties. Now under IAS 40, that the purpose is investment, right? Since the purpose is investment, now you will be showing any income, meaning gain on fair value changes, right? Revaluation gain at the end of each year, or revaluation losses, or the depreciation expenses. All these would go under investing category. Okay. Or when it comes to investments that you've made, investments in debt or equity instruments under IFRS 9, right? Held through fair value through profit or loss. So any gain or losses there also will come under investing category. But if you take depreciation for PPE, right, property, plant, equipment depreciation, that depreciation will remain under operating category. But depreciation of investment property will be under investing category. Now you see, you show depreciation also under two categories, two separate categories. Okay, right. Now why have they made these changes? These changes are made to make the financial statements more useful to the users of the financial statements, right? Then an example, interest or dividends from investments, rental income, depreciation on investment properties. So here any other depreciation through operating category is what you record it. Then gains or losses on disposals of investments. So all these are going to be categorized or recorded through investing category. Okay. Then there is financing category, includes income and expenses from liabilities purely related to raising finance, such as bank loans, bonds. Interest expenses and fair value changes on financial liabilities, IFRS 9. Interest and unwinding discount on liabilities not purely financing related, right? Such as leasing, pension liabilities, or the provision unwinding cost, right? So those also come under financing category, and other related expenses are included in operating. Any other related expenses are under operating, right? So financing is what focuses on the liability section of a statement of financial position. Any the profit or loss elements of your liability section will be under your financing category. Okay, right. Then there's income tax category. IAS 12 rule applies here. Discontinued operations category, IFRS 5 rule applies here. So these are the 5 distinct categories. Now this doesn't mean that you have to show it like this is operating, investing, financing. No, you have to structure it in a way where it flows as operating, then comes investing, then comes the financing category, then the income tax category, then the discontinued operation category. So it is subtle, right? Not renamed or demarcated with operating category, investing category, like we had in statement of cash flows. We are not going to do that here. Rather, subtly we are going to record those particular element related items accordingly. First we have operating category, then investing category, then financing category, income tax category, and then discontinued operations category. Okay? Right. Apart from this, there are other changes as well. Aggregation. So here I am just giving a summary of changes. And disaggregation. Alright. And then term definitions, right? Renaming of terms, right? Terminology. We'll look at what those are as well. Okay. Right. Now comes foreign exchange difference. Now we saw depreciation, where we had investment property related depreciation under investing category, but other PP related depreciation under operating category. Likewise, now foreign exchange gains or losses, that also will fall under either operating, financing or investing category according to what the exchange gains or losses are relevant to, right? If they are related to anything to do with operating, let's say receivable, payable, foreign sales, foreign purchases, right? If those changes, any gain or loss that happens there is operating category, right? But any foreign exchange gain or loss pertaining to investments, right? Let's say I've got an investment from a foreign company, so the investment has been done in foreign currency, right? So whatever gains or losses when converting that, translating that, will be investing category related. And then if I borrowed from foreign bank in foreign currency, any translation gains or losses for that will be under financing category. Okay, exchange difference on receivables, operating exchange difference on loans, financing category, exchange difference on investments, investing category. Now you see, even exchange differences will be shown under multiple categories. You are going to clearly name it and you're going to show it under respective categories. Okay, so before we could aggregate, now that's where aggregation disaggregation comes in. We used to aggregate all the foreign exchange gains or losses and show it as foreign exchange gain or losses as one line, right? But now that is not how it works, right? You can aggregate the operating category related forex changes, right? Translation gains or losses together. Then you can aggregate the investing related together and aggregate financing related together. But you have to show those in operating category, translation, exchange gain or loss separately, investing related and financing related separately. Okay? Right. So that's to do with foreign exchange differences. And as we've already looked at how foreign operations, if there is subsidiary, right? A foreign subsidiary, any exchange gains or losses that happen while translating their performance, right? That will be remaining under OCI, but that will be recyclable to SPL at disposal. Now that remains as it is, right? Any foreign exchange gain or losses on foreign operations, meaning subsidiary, right, translation, that would remain under OCI until the subsidiary is disposed. After disposal, that will be recycled to profit or loss. Okay, that's to do with foreign exchange differences. Now, why this has been brought in? Why depreciation has been brought in? To show you how different purpose. Now, here purpose is important. Different purpose would make it categorized under different section. Okay, right. Then comes main business activities, right? Purpose including main business activities. Now, when it comes main business activity, Banks, what's their main business activity? Giving loans, right? So whatever interest income that they have, will that be financing? Will that be investing category? Now their main business activity is important, right? So main business activities. So entities assess if they have a specified main business activity, such as investing in assets or providing financing, right? If that is the main business activity, so operating category is the category, default category for main business activities, right? But what if financing and investing category related items are pertaining to the companies whose main business activity itself is investing or financing? Then what happens, right? So if investing or financing is the main business activity, relevant income or expenses usually in investing or financing categories are now moved to operating category. So for banks, interest income is going to be under operating category, not under investing category. For investing companies, investment companies, for them, the investment income is going to be under main activity and not under investing category. Operating category is what they are going to record it under. Okay, no financing category, no investing category. Rather, since our main business is investing or main business purpose is investing or financing, for them, those are going to move under operating, which otherwise for other companies would have rested under investing and financing categories. Alright? Okay. So investment property company, income from investment property is presented as operating. Bank providing loans, interest income or expenses related to lending activities presented as operating. Okay. So exception here, income or expenses from equity method investments always remain in the investing category. Right? Equity method investments is going to remain under investing category always. Alright, that's the exception here. Right. Now we are looking at how this impacts the narrative answers in SPR exam. So when you take SPR exam, as a candidate, you have to write, you have to narrate, right? You have to write answers in depth. After introduction of IFRS 18, you can't just say this is going to be under statement of profit or loss as an expense, as an income. No, now you have to be very clear. You have to clearly demarcate. If let's say there are multiple expenses under standard, right? If certain expenses are relevant to operating categories, some of them those are relevant to investing categories, some of those are relevant to financing, you have to clearly talk about it. Saying that these expenses are relevant to the main business activity of the organization, which is the sales and purchases. Therefore, these expenses or income are going to be recorded through operating category in statement of financial performance. Likewise, for investing category, financing category related expense income also, you have to narratively clearly write it out. Now you can't just say this is an expense in statement of profit or loss, income in statement of profit or loss. Expense under which category, income under which category is key here. Okay? Right, so what's the impact? Candidates must provide more detailed answers. Example, for defined benefit pension schemes, current and past service costs goes under operating category, interest component under financing category. Right? So previously when candidates answered SPR exam questions on defined benefit pension schemes, they typically only stated current service cost, past service cost, net interest expenses are recognized in profit or loss. Vague, just being very generic, right? But now under IFRS 18, examiners expect significantly more detailed and specific narrative explanation. For example, defined benefit pension scheme expenses must be split into two distinct categories. Current and past service costs directly linked to employee services and are considered part of co-operating activities, therefore operating category. Interest component, often called the net interest expense, arises from unwinding of the discount on pension obligations, therefore you are going to recognize it through financing category. So now when you talk about net IS 19 employee benefits and you are speaking about the SPL items, there you have to say this falls, this is through operating category under statement of financial performance, statement of profit or loss, and this is through financing category. The net interest component is through financing category in statement of financial performance. Okay? Right. Then gains or losses from derivatives, IFRS 9. So there is a change there as well. So derivatives are financial instruments whose value changes based on an underlying variable such as exchange rates, interest rates, or commodity prices. We know that, right? So I'm not taking all in depth, just a definition there. So gains and losses from derivatives are classified in the same category as the income or expenses of the item or hedged risk the derivative is used to manage. Now derivative is why do we get derivatives? To hedge something, right? Hedge the risk of something, right? So now with derivatives, gains and losses from derivatives are going to be classified under the same category as the income or expenses, right? So typically they are classified under operating category, but if the risk that's being hedged is pertaining to investing or financing item, so in that case it will be under investing or financing activity. For example, risk from operations, sales, purchase, inventory, commodities, operating categories where you recognize the gains or losses. Risk from borrowing costs of financing activities such as interest rate or foreign exchange borrowings, if you are hedging that risk with the derivative, so any gains or losses there will be under financing category. Then risk from investment activities, investment in assets, foreign currency investments, etc. Any hedging that is taking place to mitigate those risks, any gains or losses there will come under investing category, right? So that's how derivatives are going to be recognized, or gains or losses are going to be recognized. Again, the crux of everything is you need to understand the purpose, right? If the depreciation is for the asset that is used for investing purposes such as investment property, that will be an investing category. If it is for general PPE that's used in operations, right, for business use, that will be under operating category. Likewise, foreign exchange, if the exchange gain or loss is pertaining to usual business requirements, operating category. Investing items, if the gain or loss on foreign exchange translation, investing category. If the foreign exchange translation related gain or loss pertaining to financing items, that will be under financing category. Likewise, derivatives also generally will be under operating category, but again the gains or losses will be recognized in the category for which those are taken, right? For whatever the risk that has been hedged. Okay, any risk that is hedged, if that risk is pertaining to operating, derivative gains or losses in operating. If it's pertaining to investing, under investing. If it's pertaining to financing, under financing. So even those gains or losses will be shown under separate categories. If there are, let's say there are multiple derivatives, some for investing, some for financing, some for operating, there you have to clearly show it under three categories. Okay, right. Then comes the next new requirement, which is mandatory subtotals, right? Which is a new requirement. So there are three subtotals that are mandatory. One is operating profit or loss. Number two is profit or loss before financing and income taxes. Number three is profit or loss, the total profit or loss, right? So operating profit or loss is after the operating category. So that's how the categories are demarcated. After operating category, everything is taken into consideration. You will have operating profit. Operating profit is going to be any profit or loss that have been generated through the operating activities. Then you have the investing item, investing category. Let's say gain or losses on investment item, right? So that's the investing category. After this, you will have the next subtotal, which is profit or loss before financing and income taxes. Meaning, this is going to include the operating results, profit or loss, plus or minus investing results, right? The profit, gain or losses, income and expenses pertaining to investing items. So you add all the operating and investing, you arrive at the next subtotal, which is profit before financing and income taxes. Meaning here you have not considered financing category yet. After this subtotal, you move into the third category. Now you see, you don't need to explicitly mention saying that this is operating, this is investing, this is financing. No. Rather, through subtotals, they have subtly separated the categories, right? First subtotal is after operating category, second subtotal is after investing category, so that combines both operating and investing. Third subtotal is after considering the financing and tax category as well as discontinued operations category. Okay, that's a final subtotal. Right. Profit or loss includes operating, investing, financing, and other two categories as well. Right. So these are the mandatory three subtotals. Gross profit, not mandatory, but it's optional. You can show it, and if you want, you can avoid showing it as well. You can put all the income and expenses through operating items under operating profit itself. But still, revenue, cost of sales, gross profit shows top line. So if you want, you can still use it. There is no hard and fast rule where you should not use it. It's optional. You can use it, but mandatory are these three. So you have to make sure these three are there. Okay. Right. Then presentation of expenses is going to happen either based on function such as cost of sales, admin expenses, or by nature such as depreciation, wages, right? So by nature also you can show it as, let's say depreciation. If there is any depreciation pertaining to admin expense, pertaining to selling and distribution. So this is by nature. So you take depreciation and you show, okay, admin, whatever the assets used for admin purposes, you depreciate that. Whatever assets, let's say motor vehicle used for delivery purposes, selling and distribution, depreciation here. Okay? Right. So by function, you can have it as admin, you can have it as selling and distribution, and all the results can be aggregated as far as it provides useful and faithful information. So you see, conceptual framework remains the same. There is no change in conceptual framework. So conceptual framework, when it comes to your information being useful, what are the fundamental, what are the enhancing characteristics, those all remain the same, right? But what's happening now is there is more clarity in the financial performance. The way it's presented, there is more clarity. Whoever is reading it, they can understand, okay, this through operating, this through investing, this through financing. Okay, this is the first subtotal, okay, operating result. This is the second, the profit before financing and income taxes, right? Then the profit or loss, right? So this gives more clarity, okay? Then aggregation, disaggregation also gives more clarity. We'll look at when we are discussing aggregation and disaggregation, okay? Right. So moving into the third new item, that is aggregation and disaggregation. So items with shared characteristics, you can aggregate clearly. Items with distinct characteristics, you have to disaggregate separately. Aggregation being combined together, disaggregation show separately. Right. Now let me tell you. Now there are certain costs that are incurred every month, right? Recurring costs. Then there are certain costs that are non-recurring, right? Such as gain from sales of PPE. Non-recurring, right? Although it's an operating category, now you can't add it under recurring items. All the recurring items you can combine together, aggregate them together, recurring items. But any non-recurring one-off item, you have to disaggregate and show them separately so that it indicates to the users this is an item that might not recur. Right? So that's why disaggregation plays an important role in again making the information more useful. Right? Why? Now when the users see, they understand, okay, if there are the aggregations, these are all with similar characteristics. Disaggregation done for one item, meaning this is not going to be recurring. Impairment of goodwill, it will not happen all the time, right? So that also you show as a disaggregated item. And whatever you are aggregating also, in the notes you will be showing the details of aggregation as well. Okay? Right. So aggregation, which is grouping in other terms, items sharing similar characteristics should be clearly aggregated. So aggregation improves clarity and avoids overwhelming users with unnecessary details. So why aggregation is useful? So that the financial statement is not cluttered with all the information that can be aggregated together. If it is aggregated together, it's simple, clean structure where a user can read, understand, and will not be an inconvenience for them. Okay? So administrative, you can include salaries, rent, utilities, stationery expense. Now you don't need to show all of these separately. Rather, you can aggregate them under admin expense. But in notes, you'll have to show the detail of aggregation. Selling expenses, advertising, sales commission, delivery cost, you aggregate under selling expense, show one figure. In detail, through note, you show it in detail. What go into your selling expense, right? So expenses with similar role are grouped clearly. Then disaggregation, separation. Why do you separate? So items with distinct characteristics must be separately disclosed to highlight their unique nature or significance, right? So any item with unique nature or any item that's significant, you have to disaggregate that and show separately, right? So it ensures significant or unusual items stand out clearly for analysis, right? So goodwill impairment, you disaggregate and show. Why? Because it's significant non-recurring item unrelated to routine administrative costs, not related at all. So you show it separately. Restructuring expense, distinct, non-recurring, right? It's a distinct item and it's non-recurring again. Restructuring is non-recurring, it's not going to recur always. Restructuring happens on and off, right? So you show that separately. So users understand, okay, there have been a one-off expense that have happened. There have been a non-recurring expense that have happened. So now they can make decisions accordingly. They can anticipate, okay, this won't happen next year, right? That's why we disaggregate. Clear disaggregation ensures users notice significant or unusual expenses promptly. Alright. Then the terminology, that's what you call labeling, right? Labeling is the other new introduction. So here you cannot use vague labels. Avoid vague labels like other. Now you can't use other income or other expenses. Why? This was used as dumping ground. No? Other income, you dump all the income under this. Now you can't do that. Other income, other expense, you need to avoid. You need to clearly name those, right? If other income included rental income, you have to clearly name it as rental income, right? Other expenses, if it was to do with foreign exchange gain or loss, you have to be very clear. Loss on foreign exchange translation. You can't put it under other expenses. Okay? So now other income, other expense, or use of other, you can't. You need to avoid vague labels, right? You need to make it as clear as possible. But let's assume it's not possible to clearly name it. So in that case also you need to make the category clear. Is it other operating income, other investing income, other financing income, other operating expense, other investing expense, other financing expense? So now you are making it clear under which category is this other relevant to. Right? So you can't write other income, you can't write it as other expense anymore. If you are writing other income, other expense, when clear labeling is impossible, not practical, in that case also you have to clearly write whether it's other operating income, other operating expense, other financing expense, other financing income, other investing income, other investing expense. So that clarity is required. So use descriptive labels clearly showing the nature of included items. If other is unavoidable, clarify what other is that. Okay? So that's the labeling example. Now here, poor labeling, other income, other expenses, poor labeling. Improve labeling as per IFRS 18 guidance, rental and dividend income. Impairment and restructuring expenses. So these are clear labeling done. Right? Non-recurring expense you are showing with their names. Yeah. Acceptable use of other investing income, which includes dividend income from small value equity investment, other operating expenses, miscellaneous expense, individually immaterial but collectively relevant. Right? So these are acceptable in case clear labeling or improved labeling is not possible. But this you cannot. Okay? Right. Then comes management defined performance measures, MPMs. We've looked at what APMs are, but now we are going to look at what MPMs are. Alright, so now this session is focused on both FR and SPR. As I told you, I'm taking you into the depth of SPR. So FR students, take the crux, whatever is important to you all, take that out of this, and whatever seems irrelevant to you all, keep that in mind for SPR. Alright? Okay. So MPMs are specific subtotals of income and expenses used externally to show management's view of performance. Remember, management performance measures are subtotals, while APMs are any measure. It can be any measure. MPMs clearly subtotals. Okay, so it is to do with subtotals, right? It must not be subtotals required by IFRS. Right, management of defined meaning, it should be management defined. When management comes up with subtotals for their own thing, right? So that should not be a subtotal required by IFRS. Must be publicly communicated, such as adjusted operating profit could be one management performance measure. Adjusted operating profit, maybe, and they clearly explain why they've adjusted it. Must disclose clearly what performance aspect is shown and why it's useful. Calculation method, reconciliation to IFRS subtotal as well, right? So once you bring your management defined performance measure, you bring the reason why you've removed certain expenses, if at all you removed, and then you show reconciliation also. If you add this back, this is how the IFRS defined subtotal looks like, right? So that subtotal is what management defined performance measures are. Additional performance measures still examinable in SPR, such as free cash flow, net financial debt. These are an APM, not an MPM, right? Again, these are the difference between APM and MPM. Required by IFRS, both are not required. Must be subtotals. APMs, no, can be any measure. MPMs, yes, it should be a subtotal. Okay? IFRS 18 disclosure required. APMs not required, but MPMs, yes, detailed disclosures are mandatory. Why you've used that? What will be the reconciled subtotal? You have to reconcile also show. So that's detail required. Examples: net debt, free cash flows, EPS, earning per share. These are all any measures, right? Not only subtotals, but here it's adjusted EBITDA, co-operating profit, right? So these are all subtotals. Income minus expense subtotals. All right. Okay. What's the impact on cash flow statements? IAS 7 amendments. There are IAS 7 amendments also that IFRS 18 is impacting, such as IFRS 9 presentation, that also we already saw. IAS 21 presentation we already saw. Now there is IAS 7 presentation change also. Now reconciliation starts from operating profit. Before it was profit before tax, right? Now it's operating profit, a clear term given. You can't use any other profit to start your indirect method. You will start reconciliation of your indirect method using operating profit instead of profit before tax, right? In terms of your indirect method. Cash generated from operation is replaced. So terminology clarification is done here, so there's no clarity. Cash from operating activities before income taxes. Now before what happened? Operating activities had income taxes minus deducted and interest paid deducted from the same category, right? But now only income taxes will be deducted from there. Therefore, cash generated from operations term changes to cash from operating activities before income taxes. And the interest paid moves from operating to financing. No any other presentation allowed. You will have to show interest paid under financing activity, right? Adjustments in reconciliation limited to operating items only. Interest and dividends paid now generally classified under financing activities with exceptions for specific main business. If it's a main business perspective, then main business, again here also main business perspective comes in, right? If it's a main business based interest paid or received, that is different, right? That might fall under operating, alright? But otherwise, any interest paid now moves away from operating to financing. Alright, so that's going to be the impact on IAS 7. What are consequential amendments, right, after IFRS 18 introduction? So there are certain principles from IAS 1 that have moved under IAS 8 now, right? So IFRS 18 did not take everything from IAS 1, rather it took whatever was important and it added more things. But certain things that IFRS 18 did not take were moved under IAS 8. Now IAS 8 has also been renamed, right? So IAS 8 was policies, changes in accounting policies, estimates and prior period errors. But now the IAS 8 standard name has been renamed as basis of preparation of financial statements, right? So going concern, a section from IAS 1 has moved under IAS 8, right, as a complete section. Accruals accounting, fair presentation, disclosure of accounting policies, estimation, uncertainty disclosure. So all these have moved from IAS 1 to IAS 8. And you won't see this under IFRS 18, right? So what is the implications of IFRS 18 for SPR exam? Detailed adjustments and evaluations of draft financial statements are required. Candidates must identify errors in presentation. Now you should be in a position to identify errors. If certain investing item related income or expense are recognized under operating, you have to identify that this is an error. Investment property depreciation should not be under operating, it should be under investing. So you identify the errors. or even subtotals. Let's say they've just given 2 subtotals, third subtotal is missing, 3 subtotals are mandatory, so that's also an error. So you have to show that the third subtotal is mandatory, which is missing, right? So those are correction of errors. Classification must identify proper classification. What is under operating, what is investing, what is financing, what is main business. You need to know exact classification. Foreign exchange gains or losses, where would it go? Exactly, you should know. Subtotals or omitted information, anything that's omitted, that also needs to be identified, right? So the candidates must identify errors in presentation, errors in classification, errors in subtotals, or any omitted information. Alright, so you need to know IFRS 18 requirements and even aggregation, disaggregation. Let's say certain things that should have been disaggregated, if they've been shown under aggregated item, that also is an error, right? Anything that should have been aggregated, shown separately, that also can be highlighted. Okay, and labeling, if other expenses, other income label is still used, that also should be captured or highlighted. Alright. Explicit evaluation of aggregation, labeling, and presentation requirements of IFRS 18 is also mandatory. Right. Implications for FR exams: start statement of cash flows, indirect method with operating profit, clearly classify dividends paid and interest paid under financing activities, present mandatory subtotals such as operating profit, profit before financing, income taxes, and profit for the year explicitly in your financial statement in section C if you are preparing. Then be cautious with ratios, carefully select correct subtotals for calculation. Now even ratio subtotals will change because there is no profit before interest and tax anymore. So you should know what to use accordingly. Now this is how a pro forma statement looks like. Operating items, you see subtly there, right? This is an optional subtotal, this is a mandatory subtotal. Gross profit optional, operating profit mandatory, profit before income taxes optional subtotal, right? Profit from continuing operations optional subtotal, right? Profit, this is mandatory, right? This is mandatory subtotal. Okay. Then profit before financing and income taxes is also mandatory. So what are mandatory? Operating profit, profit before financing and income taxes, profit. Whatever is shown in bold letters, that is mandatory subtotals. Then revenue, cost of sales, gross profit, that's optional subtotal. Other operating income, they're being very clear, labeling is clear. Selling expense, research and development expense, general and administrative expense, goodwill impairment loss, other operating expense. Now this is disaggregated, right? And then any disaggregated item you show it separately. So here it's just a pro forma. So any other item also will go under here, right? Those are operating. So you see, you're not saying now you're not going to bring in like operating activities. No, you're not going to separate it like that. Rather, in the presentation, you are bringing operating items first, investing, financing separately. Alright. Then, after operating items are brought in, you have operating profit that separates. Then the investing items, share of profit and gains on disposal of associates and joint ventures, then any depreciation of investment property, gain or loss on investment property, all that will go under this category. Right? And then, after you take this total, you add all of these total, you arrive at the next category, which so the next subtotal, which is profit before financing, income taxes, again operating plus investing, right? Then you move further, interest expense on borrowings and lease liabilities, interest expense, these are financing items, right? There could be interest income also, right? If at all, right? Or reversal of interest expenses. So any financing related items will be here, right? Profit before even unwinding expense, right? Then profit before income taxes optional, not mandatory. Income tax expense, after you have income tax expense, that is the next category, income tax category, right? So that focuses on IAS 12, so you should need to know IAS 12 standard. Then profit from continuing operations, again optional subtotal. Loss from discontinued operations could be profit also, so that is going to be a discontinued operations category. You see again subtly there, right? Then profit attributable to own of the parent, non-controlling interest. So presentation changes, it's not just for individual, even for consolidated financial statements, which is why a consolidated statement of financial performance, that's position, this performance, right? Changes to any other financial statements, there is not much, but clarity requirement is there, right? Goodwill you show separately under non-current asset item, right? Because that is a different item, so you don't aggregate it together. Okay, right. These are summary of changes for your quick recap, right? So just have a look at it. Take a screenshot if you want to. And then these are the other changes to SBR syllabus applicable from September 2025 to June 2026. IFRS 18 we discussed in detail. IFRS 19, a very small section has been introduced here, so be prepared with that. IAS 7 we discussed what changes are here. IAS 8 we discussed the renamed version. Integrated reporting is removed. Issues in financial reporting is also removed. So those are the changes for SBR exams. I hope you all got a clear, in-depth understanding of what IFRS 18 is. Now if you all are or you all should be able to face IFRS 18 related questions, and you all should be ready and prepared to prepare a statement of financial performance adhering to IFRS 18. Wishing you all the very best. If you ever have any questions, any doubts regarding any of the IFRS 18 changes or anything else, you can always reach out to me. All the best for your future endeavors.